Vancouver and Toronto. Joining me from Vancouver is R Campbell. He is Senior Analyst for the Real Estate Investment Network and author of the best-selling Real Estate Investing in Canada, to talk to us a bit about what's happening in the real estate market. Don, nice to see you.
Great to be back. Thank you.
Let me ask you first off, just off the top, are all Bank of Canada rate cuts created equally in your eyes? I mean, do they all have the same impact, or is it when rates are so low, it just doesn't matter as much anymore?
You are absolutely correct. You know, that when you're in that 6 and 7% and above, I've had 16% mortgages. When the rate drops, then it has a much stronger impact on the housing market and the ability for people to get in, or the wants to get in. Now, when you're sitting at 3 and less, as a matter of fact, you're in the 2s if you're getting variable rate mortgages, et cetera. The quarter point drop, or as the banks move to 0.15 drop, really is a bit nonsense. It doesn't change the market at all. Although you'd be confused if you read all the newspapers about it that this was going to be a big deal.
Well, I was going to ask you, so have you seen much follow-through? I mean, in terms of what people you've talked to, and I know, again, I'm not pretending there's a national market, but let's take Vancouver as an example. Are you seeing much follow-through from the rate cut?
None whatsoever, as a matter of fact, because the banks are playing this much more intelligently than they did many years ago, and they've actually tightened the lending rules. And even on the variable rates, even though you're down at that 2% range, you still have to qualify for a much higher rate. So a drop in the variable rate doesn't really affect your ability to get a mortgage, although your payments would be lower. You still have to jump through the qualification hoop, which is exactly what this country needs, is to make sure that we're not just giving money out everywhere so everybody goes into deep debt that they can't afford.
There's a few things I want to chat with you about, but if I could, people always love to hear this, and you know this, but if you were to highlight 3 markets in Canada which you see right now are quite overvalued, and then 3 markets which you think are fairly priced in terms of where the growth is and what looks interesting from an investment standpoint, who would you look at first from the overvalued standpoint?
Well, I look at markets as a yield potential because I look at it as an investor, obviously. And I would say that your most difficult markets right now to get yield, which means it could be considered overvalued based on rent, would be Vancouver, especially the downtown core. I would say Montreal is one of them for sure, because we've seen values go up but rents not move. And also the ground-oriented units in Toronto and the GTA. Because the condos, not so much. You're getting pretty decent yields still in a lot of the ones that are coming onto the market. But it's those ground-oriented units because prices there have just skyrocketed. That's
fascinating. I don't think, and I probably don't follow this as closely, obviously, as you do, but people kind of hear about condos, that's the problem. Yeah. And people say, oh, no, safety and you say, the detached or semis and those kinds of things. You're saying, no, that's where it's hard to get that yield.
It's hard to get the yield, but that's where your price growth is going to be. So if you are in the world of just capital gain and you don't really care about the rent that it's going to collect, the ground-oriented unit is going to be your best play for the next 5 to 10 years because they're not making any more dirt, except maybe in the Netherlands. But they are going up, and it's easier now to create condos and put a couple of hundred units on the market versus a bunch of row houses or semis.
Okay, let's talk about the other side then. What would you say are the most fairly valued markets and where you think it's the easiest to make a return?
I tell you right now, with the demographics that are coming and the economics that are coming and the revitalization and the transportation, there is no question that Hamilton would be a place where I would be putting my cash for yield and long-term equity growth. Number 2 would be that tech triangle, like Kitchener, Cambridge, Waterloo region, although Waterloo has some structural issues around being a landlord. But Kitchener, Cambridge, for instance, demand is strong. They're keeping the young millennials after they graduate in the city, in the region, and that's going to be the big driver. And then, as we were just hearing from your previous guest, let's take a look at one city that's a surprise. It's still giving us yield. Our rents are going up, and that would be Edmonton. I would not hesitate at all to put more money into Edmonton. As a matter of fact, that's exactly what I'm doing.
Well, and explain that with Edmonton, because again, based on a superficial analysis, people go, well, oil prices aren't great. Edmonton's, closer to Fort Mac, perhaps, and others. I mean, you could get the fact that, the oil side of things just isn't doing so well. So why is Edmonton a good idea?
Well, we've got to remember that at the same time when the Bank of Canada dropped their rate, it was really, for me, a currency play. So that's really put Canada on sale. So we have those fixed costs, as we just heard, in Canada for our oil, but we're getting about $65, $67 for our oil right now because of the U.S. dollar exchange. So it's not as horrendous as it seems for a lot of the companies that are already in production. It's the new ones that are going to be the ones that are going to be concerned. Mm-hmm. The new projects they're just waiting for new government regulations, et cetera, et cetera. So we're not seeing the population moving. We are seeing some selling, but they're not leaving the city. They're selling still with their jobs, trying to jump the market, and they're renting. So our vacancy rate is next to zero and our rents are going up. So the yield is very strong.
Okay, I've only got about 90 seconds, Don. I want to play a little notable versus noise. Lots of headlines we see.
Do I win something?
You can win a mug. Here you go. We'll send one out to you. Right. So, okay. So first off, lower mortgage rates. Is that notable or noise?
Right now, it's noise because the mortgage rates are so low that it doesn't have an impact.
Monthly housing starts announcements. Should we pay attention? Notable or noise?
Drive you crazy. People say the housing starts is a reflection of the housing market. It's not. It's a great reflection of construction jobs and and on investments, because the majority of them right now are multifamily and condos. So the starts don't actually play into the market for two and a half years. So I am saying right now, monthly are noise.
Okay, U.S. short sellers betting on a Canadian housing crash, an accident waiting to happen. Noise or notable?
Noise.
Yeah?
Noise, because there's no such thing as a Canadian housing market. And for people to short the Canadian housing market, good luck to them, because I'll tell you right now, it's strong and very, 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 in a lot of markets. And at the same time, they've been calling for us to crash since 2006. If you've kept your money in the market, you've done very well. It could go down 20%, and the majority of us won't be hurting.
5 seconds left. Micro suites, tiny condos, these little itty-bitty places that are coming on the markets.
Fantastic right now. If you're building them and selling them, fantastic right now. In 10 years, there's going to be a problem. There's not going to be the demand for those because the demographics will work their way through them. So you're going to have a problem.
Don, always a pleasure. Thanks so much for joining us tonight.
My pleasure. Thank you.
Don Campbell will send you a mug, Senior Analyst for the Real Estate Investment Network. Thank you so much for joining us. If you have any comments,